Bernie Madoff built a $65 billion fraud that fooled Wall Street elites for decades. Bernie Madoff appeared trustworthy to bankers, celebrities, and wealthy retirees worldwide. His investment empire collapsed during the 2008 financial crisis. Thousands of victims discovered their fortunes never actually existed. Some families lost retirement funds built over entire lifetimes. Others lost charities supporting hospitals, schools, and struggling communities. The scandal destroyed reputations across Wall Street overnight. Federal investigators uncovered decades of forged statements and fake profits. Madoff secretly operated the largest Ponzi scheme in American history. His office looked professional, calm, and completely legitimate. Employees rarely questioned where the profits actually originated. Many workers believed Madoff possessed unmatched investment genius. That reputation became the perfect disguise for financial crime. Bernie Madoff started his business during the early 1960s. He began with modest investments and a growing customer network. Over time, powerful investors introduced friends directly to Madoff. Exclusive access made his investment fund seem even more desirable. Potential clients sometimes waited months for approval into the fund. Scarcity convinced investors they discovered a rare financial opportunity. Madoff promised stable profits regardless of stock market volatility. That promise attracted nervous investors seeking safety during uncertainty. Most hedge funds experienced losses during market downturns and crashes. Madoff claimed his strategy avoided those painful investment disasters. Year after year, clients received nearly identical positive returns. The consistency should have raised immediate suspicion among professionals. Real markets never produce perfect profits every single year. Madoff carefully avoided attention from ordinary retail investors. Instead, he targeted wealthy circles filled with social connections. Country clubs became recruiting grounds for future victims. Palm Beach communities praised Madoff as a financial wizard. Jewish charities trusted him because respected leaders endorsed his business. Word spread quietly through elite social gatherings and private dinners. Madoff understood people trusted familiar names more than evidence. That psychological trick protected his scheme for decades. Victims believed wealthy insiders already verified every investment detail. Nobody wanted to appear suspicious around successful, powerful investors. Questioning Madoff risked exclusion from elite financial circles. Fear of missing wealth kept many victims completely silent. One fictional investor, named Daniel, invested his family inheritance with Madoff. Daniel believed consistent profits guaranteed his children's future security. His monthly statements always showed healthy, growing account balances. Daniel proudly convinced relatives to invest alongside him. Those referrals unknowingly expanded Madoff's fraud across multiple generations. Another fictional victim, named Laura, managed a children's charity foundation. She trusted Madoff after recommendations from respected board members. Laura believed investment profits would fund scholarships for struggling students. Her organization eventually lost every dollar inside Madoff's accounts. Some charities permanently closed after the scandal became public knowledge. Victims described overwhelming shame after recommending Madoff to close friends. Families stopped speaking after arguments over destroyed retirement savings. Madoff did not steal numbers alone. He destroyed relationships too. The actual fraud was surprisingly simple beneath the expensive reputation. New investor money secretly funded withdrawals for older investors. No massive investment strategy generated the profits shown on statements. The money simply moved between accounts to maintain appearances. As long as investors avoided large withdrawals, the illusion survived. Madoff depended completely on constant streams of fresh investment cash. The operation collapsed immediately whenever withdrawal requests became overwhelming. Financial crises are deadly for every Ponzi scheme in history. Investors panic during recessions and suddenly demand their money back. That exact pressure finally shattered Madoff's carefully protected empire. During 2008, global markets experienced devastating financial panic and uncertainty. Banks failed while investors desperately searched for emergency liquidity. Madoff suddenly lacked enough money to continue the illusion. Clients requested billions in withdrawals within a very short period. Madoff realized the scheme could no longer survive mathematically. He confessed privately to his sons inside his Manhattan apartment. Madoff admitted the entire investment business was one massive lie. His shocked sons immediately contacted federal authorities about the confession. Agents arrested Bernie Madoff the following morning. News spread across Wall Street with unbelievable speed and panic. Television networks interrupted programming to report the shocking allegations. Many victims initially refused, believing the accusations were true. The illusion collapsed faster than anyone expected possible. Investigators uncovered fake trading records dating back many years. Account statements displayed transactions that never actually occurred anywhere. Some trades happened on impossible dates or non-existent market conditions. Auditors should have identified those warning signs much earlier. The Securities and Exchange Commission repeatedly ignored serious concerns about Madoff. Financial analyst Harry Markopolos warned regulators for nearly 10 years. He concluded Madoff's returns were mathematically impossible and deeply suspicious. Markopolos submitted detailed reports explaining why the operation seemed fraudulent. Regulators failed to conduct serious investigations, despite repeated evidence submissions. That institutional failure intensified public outrage after the scandal exploded. People realized powerful institutions failed to protect ordinary investors. Victims included celebrities, teachers, retirees, and international banking organizations. Actor Kevin Bacon reportedly lost substantial investments connected to Madoff accounts. Baseball owner Fred Wilpon faced enormous financial consequences after the collapse. European banks discovered huge exposure to Madoff's fraudulent investment operation. Some retirement communities lost nearly every shared investment account entirely. Several victims reportedly experienced severe depression after losing lifetime savings. One elderly investor died shortly after learning about the fraud. Families struggled paying mortgages after retirement funds disappeared overnight. College students suddenly lost tuition support promised through family investments. For countless families, the emotional damage never truly disappeared. Bernie Madoff eventually pleaded guilty to multiple federal crimes. The court sentenced him to 150 years inside federal prison. Many victims attended hearings hoping to confront the disgraced financier personally. Some cried, describing destroyed dreams and financial devastation before the judge. Madoff apologized publicly, but many considered the statements completely empty. Investigators spent years recovering money for victims through asset seizures. Some victims eventually recovered portions of their original investments. Others never regained enough money to rebuild their lives comfortably. Madoff's luxurious properties became symbols of greed and deception afterward. The scandal inspired documentaries, books, interviews, and major television productions. The warning signs existed, but too many ignored uncomfortable questions. Madoff succeeded partly because people desperately wanted guaranteed financial security. Greed, combined with fear, creates dangerous blindness inside financial markets. Investors ignored impossible returns because profits continued arriving every month. The scheme survived through trust rather than complicated financial innovation. Madoff manipulated social proof better than almost any criminal before him. People assumed wealthy insiders already confirmed everything was legitimate. That assumption prevented deeper investigations from ordinary investors and journalists. The scandal permanently changed conversations surrounding investment transparency and oversight. Modern investors now question unusually stable returns much more carefully. The lesson remains brutally simple. If returns seem impossible, investigate deeper. Some fraud experts compare Madoff's deception to psychological cult manipulation techniques. Victims often defended Madoff aggressively before the scheme collapsed publicly. Many investors rejected criticism because admitting doubt threatened their personal pride. Successful scams frequently exploit emotions instead of advanced technical complexity. Madoff understood human behavior as effectively as financial systems themselves. His calm personality convinced victims they were dealing with extraordinary professionalism. The scandal revealed dangerous weaknesses within elite financial culture and oversight. Wall Street often rewarded reputation more than careful, transparent accountability practices. Madoff exploited every weakness hiding beneath that culture of prestige. Support the channel by liking, commenting, and subscribing for more stories. Bernie Madoff's lie proved even Wall Street experts can become willing victims.